Welcome back to Report of Silver, where we break down the gold and silver markets like analysts, but explain them in simple, practical English, so every investor can understand what is really happening beneath the headlines. Before we look at a single chart or a single price level, I want you to focus on one question tonight. Was Friday's silver collapse the beginning of something worse, or was it the setup for the next major move higher? That is the question sitting in front of every precious metals investor as markets reopen on Monday, May 18th, 2026. And I can tell you this, what happened on Friday was not random. It was not just panic selling. It was not just profit taking. It was a message from the market. And if you understand that message correctly, it tells you exactly what kind of week may be coming next. So stay with me all the way through this analysis, because the pieces matter. Before we begin, I also need to address something personal and important.
Many of you already know this, but the main channel, OG John AG 2.0, is gone, completely removed. It has been erased from YouTube. Months of work, years of audience building, thousands of comments, and an entire archive of silver and gold analysis disappeared overnight. I warned you this could happen. I said repeatedly that demonetization was only step one, and termination was likely the final step. Now that moment has arrived. That matters because it proves something I have been saying for a long time. If your platform depends entirely on one gatekeeper, you are vulnerable. That is why this backup channel matters. That is why rebuilding matters. And that is why this analysis continues no matter what happens. The data does not stop, the work does not stop, the desk stays open. Now let us move directly into the silver market because the opening conditions this week matter more than most people realize. As trading opens in the Sydney and Singapore handover, silver is sitting near 76.34 per ounce. That might sound stable on the surface, but do not let that small bounce fool you. It comes after one of the most violent single-session drops we have seen this year. On Friday, silver closed near 75.89, after touching lows near 75.75, and depending on which feed you watched, the metal fell somewhere between 9% and over 10% in one trading session. That is not a normal move. That is a market repricing risk aggressively. Gold also took damage, closing around 4,464, while silver's gold ratio widened toward 59-1, a sign that silver underperformed badly. Now think about that. Silver entered this year with enormous momentum. In late January, it touched an all-time high near 121.67 per ounce. That was historic. Investors believed the metal was entering a new structural bull market. But today, silver sits nearly 37% below that peak. That means something important. It means the market is no longer trading purely on optimism. It is now forcing investors to choose between fear and conviction. Those who bought silver because it was moving higher are now nervous. Those who understand the structural story are asking whether this pullback is an opportunity. To answer that, we need to understand what broke on Friday. The first major fracture came from geopolitics, specifically the Trump-Beijing summit. Going into that meeting, markets expected progress. The entire rally from March into early May was built partly on hope that tensions between the United States and China were stabilizing. Silver ran from roughly $67.90 in March to over $87 by May 13th, largely because traders believed the 90-day tariff truce would extend and reduce global uncertainty. But that did not happen. Instead, the summit ended with almost nothing. No real agreement on Taiwan, no breakthrough on semiconductors, no rare earth framework, no clear policy on reopening the Strait of Hormuz. The only visible result was a Boeing aircraft order. That is not what the market wanted. Markets had priced in diplomacy and received symbolism. That is why silver sold off so hard. Investors realized the optimism was premature. In one afternoon, months of trade hope started to unwind. But geopolitics alone did not cause a 10% collapse. The second fracture was inflation. And this is where things became much more serious. The April CPI report came in hotter than expected at 3.8% year over year. Core inflation remained elevated. Then the producer price index came in even hotter. Wholesale inflation surged 1.4% month over month and 6.0% year over year, the strongest reading in years. That matters because it tells the Federal Reserve one thing: inflation is not dead. And when inflation is not dead, interest rates stay high. That changes everything for silver. Remember, silver is a non-yielding asset. It does not pay interest. When rates rise, the opportunity cost of holding silver rises too. Suddenly bonds look more attractive. Cash looks more attractive. That is why Friday's reaction was so violent. Investors immediately repriced the idea that the Federal Reserve might cut rates this year. That expectation collapsed in real time. So as this week begins, silver is standing at a crossroads. Was Friday simply panic, Or was it the market warning that a deeper correction is coming? That is what we will answer next, because once we look at the rates market and the Federal Reserve, the picture becomes much clearer. As we move into the second part of this analysis on report of silver, we need to look at the one force that probably mattered more than anything else in Friday's sell-off: the bond market. Most retail investors watch the silver chart, some watch gold, a few watch the dollar. But professionals, they watch the bond market first, because the bond market often tells you what is about to happen before the metals market reacts. And on Friday, the bond market delivered a very clear message. Interest rates may stay higher for much longer than investors expected. Let us begin with the 10-year U.S. Treasury yield. By Friday's close, it reached approximately 4.59%, its highest level since early 2025. That is a major move. The 2-year Treasury yield, which reacts more directly to Federal Reserve policy expectations, climbed to roughly 4.09%, the highest level in about 14 months. Those numbers may not sound dramatic if you do not follow bonds every day, but for markets, that is a huge repricing in a very short amount of time. It means traders suddenly believe the Federal Reserve is not close to cutting rates and may actually need to raise them again. That belief changed quickly. Just a couple of months ago, many traders believed the first Fed rate cut could happen as early as June 2026. Some pricing models showed nearly a 48% probability of a cut. That expectation has now collapsed. According to the CME Group FedWatch tool, the probability of a June cut has dropped below 8%, while the probability of no cuts at all in 2026 is now dominant. Even more importantly, markets are now pricing in a real possibility, somewhere between 30% and 50% depending on the contract, that the Fed could actually raise rates before year-end. Think about how dramatic that shift is. In less than a week, markets moved from "when will cuts begin" to "could the next move be a hike?" That is why silver reacted the way it did. Silver is highly sensitive to real interest rates because it carries no yield. If investors can suddenly earn more by holding government debt or cash, the immediate pressure on silver increases. That does not destroy the long-term bull case, but it absolutely creates short-term pain. Now let us add the dollar into this picture. The DXY closed around 99.27, strengthening as yields rose. A stronger dollar usually creates another headwind for silver because metals become more expensive in foreign currencies. That often reduces short-term demand. So Friday was not just silver weakness. It was silver being hit from two sides at once: rising yields and a stronger dollar. That is a difficult combination for any precious metal to fight. But this story goes deeper because the Federal Reserve itself has changed. On May 13th, the United States Senate confirmed Kevin Warsh as the new Federal Reserve Chair. That is a historic moment. He was confirmed by a 54-45 vote, the narrowest confirmation margin ever recorded for a Fed chair. That alone tells you how politically sensitive this moment is. What makes this even more unusual is that outgoing Chair Jerome Powell did not simply disappear. He remains on the Board of Governors during an ongoing investigation. That means, for the first time in generations, the old chair and the new chair are effectively sharing institutional space. That creates uncertainty inside the Federal Reserve itself. Why does that matter for silver? Because markets hate uncertainty in central banking. If investors believe the new chair will be more hawkish, more willing to fight inflation through tighter monetary policy, then silver faces additional pressure. And that appears to be exactly what markets believe. Several members of the Federal Open Market Committee have already signaled discomfort with any talk of easing. At the last meeting, there were multiple dissenting votes. Some members openly argued that the easing bias should be removed completely. That means Warsh walks into his first official Federal Open Market Committee meeting with enormous pressure. He inherits the hottest inflation data in 4 years, rising oil prices, and a divided committee. He also inherits expectations. If the June dot plot removes the previously expected rate cut for 2026, markets will read that as a major hawkish signal. And if that happens, silver likely remains under pressure through the summer. That does not mean collapse. It means consolidation. There is an important difference. A collapse suggests structural failure. Consolidation means the market is pausing, repricing, and deciding what comes next. That is exactly where silver appears to be right now. But there is one more piece investors must understand, and it may be the most dangerous variable of all: oil. Because while traders are focused on rates, a separate inflation engine is still burning underneath the entire system, and that engine is the Strait of Hormuz. If that pressure continues, everything changes again. That is where we go next. Now we move into part 3 on report of silver, and this is where the analysis becomes even more important. Because underneath everything we just discussed, underneath the inflation numbers, underneath the bond market repricing, underneath the Federal Reserve transition, there is a deeper force pushing this entire market structure. That force is energy. More specifically, it is oil. And right now, oil is acting like gasoline poured directly onto the inflation fire. The center of that story is the Strait of Hormuz, one of the most strategically important shipping lanes on the planet. Nearly 1/5 of the world's seaborne oil normally moves through that narrow passage. Before this crisis began, roughly 70 ships per day passed through it. Today, that number has collapsed to only a small fraction of normal traffic. Depending on the day, reports suggest only 2 to 5 vessels are making the trip safely. That is not a slowdown. That is a structural disruption. And that disruption matters because it changes energy prices immediately. By Friday's close, West Texas Intermediate July futures were trading near $154 per barrel, while Brent crude was above $109 per barrel. Those are extreme levels. Oil at those prices pushes transportation costs higher, manufacturing costs higher, food costs higher, and eventually consumer prices higher. That is why the inflation data came in so hot this week. The market is not imagining inflation risk. The oil market is delivering it. The International Energy Agency warned this past week that global oil flows through Hormuz were already down by approximately 4 million barrels per day in March and April combined. More importantly, the agency stated that even if the geopolitical conflict ended within the next month, the global oil market could remain materially undersupplied through October 2026. That means inflation pressure may not disappear quickly. It may stay with us for months. Then came another major warning from Amin Nasser, the CEO of Saudi Aramco. During the company's first quarter earnings call, he explained that every week the strait remains impaired. The world effectively loses roughly 100 million barrels of available supply. Think about that number. If the disruption began in late February, then by mid-May the cumulative global impact is approaching 900 million barrels. That is not noise. That is a global supply shock. Saudi Arabia has tried to offset the problem by expanding its East-West Petroline pipeline to roughly 7 million barrels per day, the largest logistical workaround ever attempted in the region. But even that has limits. Pipelines cannot fully replace open sea shipping, and markets know it. That is why oil remains elevated. Now ask yourself, why does this matter so much for silver? Because silver is trapped between two opposing forces. On one side, higher oil prices create inflation, and inflation historically supports precious metals. That is bullish. But on the other side, higher inflation forces central banks to stay aggressive on interest rates. And that is bearish. So silver gets pulled in two directions at the same time. That creates exactly the kind of violent price action we saw Friday. This is why many investors become confused. They say, if inflation is rising, why did silver fall? The answer is timing. Inflation helps silver over the long run, but in the short run, if inflation causes interest rates to rise faster than expected, silver can sell off first before it recovers later. That is the cycle we may be entering right now. Now let us widen the lens beyond oil and look at what central banks are doing, because this is where the long-term message becomes clearer. The People's Bank of China reported its 18th consecutive month of gold accumulation in April, adding another 8 tons. That brings official Chinese gold reserves to approximately 2,322 tons. More importantly, China's first quarter gold imports exploded higher, more than 316 tons, up dramatically from the prior year. That is not speculation. That is official sector accumulation. Why does that matter for silver? Because central banks may not buy silver directly in the same way they buy gold, but they are sending a message. Their message is simple. Trust in fiat currency systems is weakening. When the most conservative institutions in the world continue buying monetary metals at record prices, they are telling you something profound about the future. And it is not just gold. In Shanghai, physical silver continues trading at roughly a $10 premium over Western spot prices. That means buyers in Asia are willing to pay substantially more than buyers in London or New York for the same ounce of metal. That is a physical signal. It tells you demand remains strong where actual delivery matters. That brings us to an important conclusion for Part 3. Friday's silver sell-off was driven by financial markets, but the physical market is telling a very different story. Futures traders panicked, bond traders repriced, algorithms sold, but physical buyers did not disappear. And that is why the next piece of this puzzle matters so much, the vault system in London and New York. Because if physical demand is still strong while inventories continue draining, the long-term silver story may be far from over. That is where we go next. Up to this point, we have covered the macro side of the silver story. The failed Trump-Beijing summit, the inflation shock, the Federal Reserve reset, and the oil market disruption feeding inflation pressure into the global system. But now we need to move from headlines into the physical market itself, because this is where the silver story becomes much more interesting. Price can move because of emotion. Price can move because of algorithms. Price can move because hedge funds decide to hit the sell button. But physical inventory tells you something different. It tells you what is actually happening underneath the surface. And right now, the physical silver market is sending a very different message than Friday's price action suggested. Let us begin in London, because London remains the largest over-the-counter precious metals trading hub in the world. According to the latest London Bullion Market Association Vault report for the end of April, total silver holdings in the Loco London system stood at approximately 27,454 metric tons. That sounds enormous, and it is. Converted into ounces, that is roughly 882.66 million ounces of silver. But here's the part many investors miss. That number is not rising. It is falling. The LBMA reported a decline of roughly 1.09 million ounces over the month. That may not sound dramatic, but remember, this is not a one-month story. This has been a gradual structural drain. Why does that matter? Because the silver market does not need all the metal in London to disappear to create stress. It only needs enough of the available metal to tighten. A large portion of LBMA silver is already allocated, already spoken for, or tied to existing obligations. That means the truly liquid pool is much smaller than the headline number suggests. Now let us cross the Atlantic to New York and look at the CME Group warehouse system, because this is where delivery risk becomes easier to measure. According to the latest warehouse stock report, registered silver inventory, the metal actually available for immediate delivery, is sitting near 80.8 million ounces. Total inventory, including eligible silver, stands around 312.31 million ounces. But total inventory has fallen by approximately 12.76 million ounces in just the last 30 days. That is important. When inventory falls while demand remains steady, the system tightens. But what makes this more concerning is the leverage ratio. Right now, there are approximately 6.22 paper claims for every ounce of registered silver. Think about that. For every ounce available to deliver, there are more than 6 claims floating around in the paper market. That works perfectly fine, until too many people demand physical delivery at the same time. And that is where the June contract becomes relevant. First notice day for June is only about 10 business days away, and more than 3,000 contracts remain open. That represents around 15 million ounces of potential delivery exposure. Now, not every contract demands metal. Many settle financially. That is normal. But if even a modest percentage of participants demand physical silver, the pressure on registered inventories rises quickly. That is why I keep telling you to watch the warehouse reports, not just the price chart. Now let us add another layer, the ETF market. The iShares Silver Trust, the largest silver ETF in the world, has experienced more than $447 million net outflows over the last month, and approximately $2.82 billion over the trailing 3 months. At first glance, that looks bearish. Investors are pulling money out of silver exposure. But here's what makes this more complicated. At the same time, those outflows are happening. Allocated physical vehicles, like Sprott Physical Silver Trust, continue attracting capital. That means investors are not abandoning silver completely. They are changing how they want to own it. They are moving away from paper exposure and toward allocated physical exposure. That distinction matters enormously. When investors choose allocated physical over paper claims, they are making a statement. They are saying, I do not just want price exposure, I want the metal. That is a confidence signal in the long-term structural case. So what does that tell us? It tells us Friday's sell-off may have been a liquidation event in the paper market, not necessarily a collapse in physical demand. Those are two very different things. Now, to be fair, this desk always gives the bearish case its full hearing. We do not ignore counter-arguments, and the bearish side has real ammunition right now. UBS cut its silver investment demand forecast sharply, from over 400 million ounces down to roughly 300 million ounces. More importantly, it slashed its silver deficit estimate from around 300 million ounces to just 60 to 70 million ounces. That is a major revision. If they are correct, then the shortage story is much less dramatic than many bulls believe. At the same time, HSBC released an updated forecast averaging $75 silver for 2026 and $68 for 2027, both below current spot prices. That matters because it tells you major institutions are not convinced this bull market resumes immediately. So now we have two competing stories. The paper market says silver is vulnerable. The physical market says structural tightness remains. And when two opposing forces collide, volatility rises. That is exactly what we are seeing. We have now walked through every major fracture line underneath this market. The failed geopolitical expectations coming out of Beijing, the inflation shock, the aggressive repricing in the bond market, the new Federal Reserve leadership, the oil disruption through the Strait of Hormuz, the central bank accumulation story, and the physical silver inventory picture in both London and New York. So now we arrive at the only question that really matters to investors. What does all of this mean for silver next? My answer is simple. Silver is not broken. Silver is being tested. There is a major difference between those two ideas. A broken market loses its underlying thesis. Its demand story weakens. Its structural support disappears. Its long-term drivers collapse. That is not what we are seeing. What we are seeing is a market that moved too far, too fast on optimism and then got hit with a reality check. That happens in every major bull market. It happened in gold in the 1970s. It happened in silver in 2011. It happened in commodities throughout multiple cycles. Strong trends do not move in straight lines. They move in violent waves. That is exactly what Friday looked like, a violent wave. Now let us revisit the bearish argument honestly, because it deserves attention. UBS has reduced its silver investment demand forecast sharply. HSBC sees lower average silver prices over the next 2 years. Industrial demand from solar is expected to decline as manufacturers continue reducing silver content per panel. India just doubled its import tariff on gold and silver, which creates immediate pressure on one of the largest physical markets in the world. Consumer sentiment in the United States just printed its weakest reading since 1952, which raises real questions about economic slowdown and demand destruction. Those are real risks. And yes, algorithmic models like CoinCodex are projecting another decline toward the mid-60s over the next week. That could happen. Silver could absolutely revisit $70 or even briefly test the mid-60s, especially if the market continues to price in a more aggressive Federal Reserve. But here is the problem with focusing only on that side of the story. It ignores the physical side. The Silver Institute still reports a global silver market deficit. In fact, this is now the 6th consecutive year of deficit. Cumulative drawdowns since 2021 total roughly 762 million ounces. That is not a small number. That is structural depletion. Shanghai continues paying about $10 per ounce, more than Western spot for physical silver. The People's Bank of China continues buying gold month after month. The London Bullion Market Association continues to show a slow but steady drain. The CME Group still shows leverage above 6 paper claims per deliverable ounce. None of those facts disappeared because silver fell 10% on Friday. They are still there. They are stacking. That is why I believe the next true inflection point is not tomorrow morning's opening bell. It is the Federal Open Market Committee meeting. That meeting matters because it will answer the biggest question in this market. Is the new Fed willing to tighten further? Or will it simply stay restrictive and wait? If the June dot plot removes the expected 2026 cut entirely, silver probably stays trapped in a consolidation range through the third quarter. That could mean weeks of frustration, sideways movement, sharp swings, emotional exhaustion. But if inflation starts cooling, or if oil suddenly stabilizes, and the Fed sounds even slightly less aggressive, silver could recover much faster than people expect. That is why I call this consolidation, not collapse. This is a market deciding which story matters more, the short-term cost of money or the long-term scarcity of real metal, and eventually, one of those stories will win. My personal view as an analyst is this: short-term volatility is high, but long-term structural support remains intact. That means discipline matters, logic matters, position sizing matters. Do not let one brutal Friday force you into emotional decisions. If you are a trader, respect the volatility. If you are an investor, respect the fundamentals. And if you are holding physical silver, understand this clearly. The people paying premiums in Shanghai are not panic selling. That should tell you something. Before I close, let me return to where we started. The original channel is gone. That chapter ended. But this desk is still here. Report of Silver continues. The mission remains exactly the same: to give you clean data, real analysis, and logical perspective in a market full of noise.